Now, to create value, you need to work on your assets, investments, financing, liquidity, everything you have here. You have to manage them properly, turn them around, invest in assets that you can sell for more than they cost you. So like this 20,000 a year, I can invest in assets, buy assets now properly, like inventory, that if I sell them, I will get a bigger return than I buy them in the first instance. You look at the screen, the responsibility of corporate finance manager are to buy assets that earn more cash than they cost in the first instance. These are one of the responsibilities of financial manager. So now, let's see how we do that. I am going to invest in inventory, say for 5,000 inventory, with the hope of selling them for more than 5,000. So what we can do is either we have enough cash here, probably my plan, I have other things that I need this money to do, I'm still seeking for more finance, I go to the market again, look for maybe a supplier who can sell to me on credit that is getting another finance. So supplier will be listed under current liability. Those are people you owe and will be paid within the year. So I approached my supplier and they agreed to give me goods on credit for 5,000. So payable $5,000. I'll credit my supplier. Thank you for providing this finance, because it's another source of finance. That's my third transaction now. And I said, what will be the opposite entry? For every credit, there will be a debit and vice versa. So I've gotten a credit of 5,000. So I'm going to debit my inventory here. Inventory. Inventory, 5,000. That's my third transaction again, noted. As you can see, all the liability equals the assets. Meticulously posting, completing your transaction as you go along, your account will balance. Not doing that could lead to differences which will now take you cost you more time and effort to sort out. So make sure you do them as you go along. So all in total now, 10, 25. My asset is 25. My liability again is 25. No value has been created still, because I'm only kind of exchanging credit, finance, and putting them into asset. I'm getting finance and putting them into assets. So no value has been added. I'm only preparing to add value. Why are we starting a business? I'm preparing to add value. That's why I'm starting a business. So now to add the value, we now have to manage all this we have here, all this asset, all this liability, okay, and liquidity available with me. Manage them properly. So you manage financing, which is fund, investment, which are machine, man, and then liquidity, which are all the cash available. Manage them, work them properly, then you see value will be created. So let me demonstrate this with my little diagram I normally use. I normally use what I call is, if you ride bike when you were young, sorry, I know it's not an age thing, we still ride bike. You have a pump, conventional pump, which you normally use if your wheel or your tire deflates to pump the tube, normally have an extended kind of pipe or flexible extension pipe here that you can attach to your tube valve to inflate the tube. Inside this cylinder, I have my finance. Inside the cylinder, I have my investment. Inside the cylinder, I have my liquidity. So they are all my financing, investment, and liquidity are inside this cylinder. So to add value, something has to happen. So the way I demonstrate this is like, if you now have your pump, a better one still is, you know, when children have birthday party, you go to McDonald's, here you see a little section barricaded and it's children birthday party. You see the balloon being pumped and hang around the environment to make it the ambience nice for the kids. Some of them holding the balloon. They use this cylinder and the pump to pump the balloon. So to do that, they put the balloon, attach it to the end of this uninflated balloon. They add it here, attach it to the pump. So this uninflated, no air in it, no air, no value, no air in it. Getting the way I'm going to now. Now by the time you pump the balloon, this item in the cylinder becomes heated, and then filling to expand. No, there's compression there, and then as it gets more heat, more pump, the balloon will now begin to inflate. The balloon will now begin to inflate. The more you pump it, so say this is level 1. Say this is level 1, first inflation. That's first value added. That's the first value added to the existing balance. I hope you're getting the gist. The more you pump it again, the more the balloon will continue to expand. So that's how the value creation, that's how value is being created. So to put a figure to what I've just done up there, this inventory I bought, I know I can make more money by properly investigating what product I need to sell for a bigger amount. So I find I can buy an investment from this supplier for 5,000, which I can sell for more. So now, because of the good planning, I'm now able to sell it. Say I sell all this inventory now to a customer. This inventory will go, if I sell it, minus 5,000. So I've sold the whole inventory. And then I will now have something I call debtor. If you haven't paid me, so debtor or receivable now. I will now have a receivable which I now sold for more than it cost me, because so 5,500. I now sold it to a customer who will pay me later for 5,500. So what I bought for 5,000, I'm now sold for 5,500. Now, if you look at this equation now, let's add up. We originally have 25,000 before I now acted. So, in sales, I can see now that I've only increased this side by 500. So this now 25,500, and this side remains 25,000. Can you see it's not balanced? The difference of 500, which is due to my action, my good action management, buying things cheaper than I can sell them. So this is the outcome of good management. Okay, value has been created. 500 pounds has been created. That is a plus, is a profit, which will now go under my equity. So I will now say profit $500. This is value creation. This is the real value creation. The earlier ones, we are merely getting myself ready to create this value. So my fourth action, which is the transaction, the selling, the operating activity, or this, the one I will note as 4. Those are my operating activity, which has now added value to my organization. Operating activity. So that is, make a sale, credit sales, you debit cost of sales. The difference is value added. Sales credit, debit cost of sales 5,000. The difference is 500 value added. So you guys can see how value is being created when firms are being managed properly by the corporate financial manager. So let's move on and see what we have in the slide. I presume you are okay up to this point. How we raise funds, where we put them, invest them in things. Never mind, we have here blank. Simple. You can buy a computer. If you debit computer, your credit bank account, so they will shift. They remain the same. You buy machine, you debit asset, you credit bank account, or you credit whichever source of finance that you have used to buy them. Both sides will continue to balance, and when you use them properly, they add value to your organization. Equity plus liability equals asset. They said equity plus liability equals asset. Good thing, we have got them headed here. Our equity here is 5,500. Let's try and close this. 5,500 is our equity here. So I will note A, B, C. A, B, C. So all these three will give us 25,500. So my A plus B, which is my liability, is A plus B. So I write my liability. First of all, there's an equity. Let's look at equity. Equity they said is 5,500. Liabilities from our board here is A plus B. Liability A plus B is 20,000. So equity plus liability will give me in total 25,500. And they say the both of them equal my assets. So what's my asset here? All this together are my assets. So let's add them all up together. Remember, same thing. 20, 25, all right? 20 again, 25, 500. So all my assets still 25, 500. All right? Assets. Assets. So as you can see, the fundamental accounting equation is correct using our figure we have used to demonstrate our corporate financing activity. So you can see clearly to you that equity 5,500, liabilities 20,000, 15 plus 5. Both of them equal all our assets 25,500. So that equation can be confirmed. So let's move on. The financial manager. The responsibilities of a corporate financial manager is to maximize value from cash. That's what we're doing here, trying to maximize the value from our cash. We got this 500 to start. We can then turn it around again. We have enough cash here. We can either pay creditor, supplier, or buy more stuff because you can see this is giving a good return. All right, you can see giving a good return, 10%. You can find more assets that can give you more than 10%, and then buy them and turn them around again, sell them, and add more value using this my demonstration. How this idea of working your financing, investment, and liquidity in order to add value to your company. So the responsibility of corporate financial manager is to maximize value from cash. How do we do that? Already demonstrated one here. Buy assets that earn more cash than the cost. We've done that here. Choose long-term investments that increase the value, firm's value. Look for investment that you can engage yourself with, that will add value to your firm. You do that by making sure you appraise those investments, like capital budgeting. Remember when we're doing that, and checking whether for instance, using tools like the MPV, the payback period, return on asset, all those way of evaluating projects, use them to choose your long-term investments. Another way to add value is to raise cheap external finances. This is cheap, no interest. We use them to buy stock that give us more money. Look for loan that you have to pay lesser interest on them, that when you invest them, your return on those investments will give a better return than that you will pay for the loan. Raise cheap external finances. Ensure efficient tax policy. Tax policy that will save you money in tax bills. If you engage in transactions that are favored by the tax regime, where you get concession, where you pay maybe lower tax rates. That will help you to add value. Make sure you do that, checking for the right thing to do or checking the tax system, and try to avoid things that will cost you tax. Tax avoidance is right, it's legal, okay? Not the other one, evasion. Do not evade tax, because the tax authority frown seriously on things like that. Evasion is illegal. Tax avoidance is okay. It means checking the system and make sure you go in, do things that will favor you. Cash is the center of all financial decisions. If you can see this slide here, it's showing us what we've actually done here. It's good we still have them on board. We've not wiped the board away. Financial market, remember, yes, we did that initially. We went to the market to get loans, to get liabilities, current liability, non-current liability, equity. All right. Total value of the firms to investor in the financial market. So we look for this. That is all the money we gotten from the market, including our equity, our total value in the market. Then we channel these funds, all these funds, we channel them to our firm. We channel them to our firm for action. We now begin to do the right things, buy the necessary assets, non-current assets, get the necessary current liability. We have a lot of them here. Okay. Then begin to work on them, as I said, to add value. Remember this 500 value added here. Then all the money we get here, we now go back again to either go and pay all these people we owing, repayments of loan, interest, dividends to shareholders if we need to pay dividends. Okay, that's one option. The other option is either we now use them to pay for taxes, because we'll be making profit now. We're going to pay the government for the work they're doing for the public, because without the work we won't have a good environment to operate in. So we need to pay. That's why it's good to pay your tax and do not evade tax. All right, because you can see the government's action here to help us. Alternatively, which is one thing to do, any excess fund, as we said, if you don't use them to pay off your debt and dividend, you can now send them back again. Retained earning goes back into the system again as a fund, as a source of fund to help more value creation. So this is how the ever-ending circle of cash in, cash out, value creation is being achieved. Cash flow consideration. Okay, cash flow consideration, identification is one of it. Cash flow or accounting figure. Which one is better? Accounting figure, if you see here now, we have no cash, not yet gotten cash from our debtor. So we have a receivable owing us 5,500. The liability, the payable is still there, not yet paid. In his book or the supplier's book, they must have taken accounting profit, it makes a profit, a sales to us, but we have not paid them. Here as well, we've taken the profit, say 500 here, but the debtor, the receivable, have not settled us. So which one do you go for? Cash flow or accounting figure? But remember, cash is supreme. We have to manage our cash properly. Without cash, we might go bust. So it's a thing you have to consider properly. The timing again. When do cash flow occur? When does cash flow occur? These ones occur when they gave it to us, the loan. This one occurred when you put into your bank account from the savings account. This has not happened. It will only happen when we pay them. Cash flow will occur when the actual physical cash is paid or received. That is when cash flow will occur. Risk, consideration. What do you think? Are cash flow risky or certain? Well, you judge it. To the supplier here, is it risky or certain? It's a question, pertinent question you have to ask yourself. For him, is that 5,000 in the hand we're owing him, is it risky or certain to him? You consider our position, our status, the way we are trading, if that is certain for the supplier to receive. Now, looking at the debtor or receivable side, is this 5,500 certain to us that we receive it, or is it risky? It's open for your judgment. So many things to consider to come to an answer. All right. Basically, if you say risky, you will not be far too wrong, because anything can happen if we didn't do our due diligence properly, credit checking properly, making sure that there are people who will pay us when the time comes. If they are not the kind of people that are good, stable in the industry, if they go bust, that is not certain. All right? So it's all open to debate. There are different goals in practice. The goal of financial manager or financial management. What are their goals? So many goals. Some, the goal is to maximize profit. Some, the goal is to maximize sales to cover the industry. Some is for survival. Some goal is to avoid distress. Some goal will be to be the best in the market. And some could be earnings growth. Earning growth, for argument's sake, years. Okay, let's see here. 20, 20, 20, 21, 20, 22. Okay? Earnings 10,000, 10,500, 10,000, 11,500. So you know how to work out your growth. The growth here will be different between the two. 500 over 10,000 times 100. That will be the growth rate for that. The next one will be the difference between this and this. I think it's 1,000 over 10,500 times 100. That is how you check your growth rates. Some will want the growth rate to be going up, 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 without coming down. All right. And you can have a target growth rate from your base. So this is how you can work out your growth rate to see how the growth rate is. Because their goal is for growth rate. So they can check that growth rate to see if they are going in line with the kind of growth rate they are looking for. Okay. Move on. The overriding aim is to maximize firm's value. All right. That's the overriding aim of corporate financial management. There are different sources of funds, okay? Financial market and the corporation. Different sources. We've actually touched all the sources practically here. This is just for you to read up. Okay. Private investor will come in somewhere here. Okay, like somebody could buy share privately from you and own share. Private investors could give you money like loan. Again, they could come in here. All right. Bank loan. It's already, we have one here already. Bank loan. Another source is bonds from market issued by governments. Short-term financing. I mentioned that this loan, there could be short-term loan here. Loan, short-term loan. There could be HP. Okay, there could be leases. All this again could be up here again. HP, the long-term portion. Okay. Leases, the long-term portion. Another sort of loans. Equity, I mentioned here already. Probably if you are quoted in the stock market, you can get issue, initial purchase offer. You can do that. Then this can be actually traded in the market for those who want to sell them. That's for listed company. For unlisted companies, you have to get it privately. Other source of fund, as I said again, among them could be your retained earning. It's another source of fund. Retained earning can be ploughed back into the organization. Okay. Things like grants from governments. Okay. So all those things, you have to look at different sources of finance. There's what we call the financial market and the corporation. We have the primary market, where the original sales of security by governments and corporation. The secondary market is where the securities that have been bought and sold, where securities are bought and sold after original sales. Like when shares are issued, you get them in the secondary market where they can be bought and sold. So, with this, I hope you've enjoyed the journey so far on corporate financial management. I will leave you with a quiz which I will read out on the screen here for you to look into. Okay. The quiz here is A. During the conversation with your manager at work, they tell you that the equity decision is a core element of corporate finance and is one of the most important decisions any firm will have to make. Are they right? Explain. What are the core elements of corporate finance? B. Explain the assumption behind the statement. The goal of financial management is to maximize the current share price. Why isn't the goal to maximize the future share price? Think about this. The third quiz here for you to look into is, why do firms or financial market exist? Why do financial market exist? Explain in details how they facilitate the flow of capital around the economy. So do this at your own time and revise what we have done today. And if you have enjoyed this particular lecture, tutorial, kind of, give us a thumbs up. Please subscribe, because it is by subscribing you encourage us to put in this time and effort to produce materials in a way that are practical for you to follow and understand. So, until I see you next time, take care of yourself and goodbye.